Taming the High Cost of College with Brad Baldridge, episode number 3.
You have kids, they grow up, and before you know it, it's time to plan for college.
Where do you start?
How much is it going to cost?
Will you qualify for financial aid?
Should you be looking into scholarships?
When will you be able to retire?
What about student loans?
The list of questions is never ending. The good news is, all the answers are right here. Welcome to the Taming the High Cost of College podcast. Here is your host, certified financial planner, Brad Baldridge.
Welcome to Taming the High Cost of College. I'm your host, Brad Baldridge. This is the third episode of Taming the High Cost of College, and in this episode, we're going to cover the second half of need-based aid. We're going to get a lot of information about the different types of programs, and we're going to dive into that. We also have a question for one of our listeners, Steve, and we're going to answer his question about the college timeline. So that's coming up as well. If you're just starting to get involved in podcasting, just be aware that you are able to get these shows directly at our website, but you can also download them through iTunes and other resources, perhaps on your smartphone. So there's ways that you can actually get these episodes to go and put them on a personal device in some way so that you can listen to them in the car or while you exercise. That's something that I learned just 6 or 8 months ago, just before I launched my own podcast. All right, well, let's get into the meat of the issue here, and we'll get started on need-based aid. This is need-based aid, part 2. In part 1, we discussed how need-based aid is calculated and help you figure out if you're going to qualify for need-based aid. Here in the second half, we're going to talk about what are the federal programs that you may qualify for. In other words, if you show a need based on your federal financial aid calculations, what federal programs could you take advantage of because you show a need? And there's 6 main federal programs out there. And then there's some additional ones that I'm just going to touch on very briefly and mention them, but I'm not really going to explain them because they're relatively tangential. But the main programs out there would be the Pell Grant, the Supplemental Grant, Work Study, Perkins Loan, Stafford Loan, and Plus Loan. All these programs are administered by the federal government. They're available to any U.S. citizen here in the United States, as well as green card holders and other people that are working on citizenship. So let's get into it. The first one is the Pell Grant. Now, the Pell Grant is a grant. Now, and grant implies free money, and that's true. It's money that you do not have to pay back. And the Pell Grant ranges from $0 to about $5,500, depending on how much of a need you have. The reality of it is most college kids that are going to receive a Pell Grant are going to be from very low-income families or an independent student. So let's talk about that. I didn't cover independent student yet. If you're the typical 18-year-old going off to college, the financial aid forms are going to ask about the student as well as your parents. Now, 25 years ago, some parents were saying, well, gee, I don't want to report all my income and assets. Well, I'm just going to throw little Johnny on the street. He'll have to go off and get his own apartment. Now he's independent and he doesn't have to report my money and my income. Well, that was abused to the point where the government essentially said, well, let's make rules as far as what it means to be independent. So now, in order to be an independent student, you need to turn 24, be a ward of the state, get married, have dependents of your own, be part of a federally funded runaway program, be part of active military service, and a couple others. But in general, most parents are not going to use an independent status as a way to pay for school. In other words, you're not going to say to your children, I know, in order to pay for college, why don't you go get married? Or why don't you have children of your own? None of those opportunities are great from a planning perspective. Now, the flip side of it is, let's say your son did get involved in active military service out of high school, and now they're back from the military, and they're still only 22. Technically, they're not old enough to be independent, but because of the military service, they are now independent. So that may also, that may be an opportunity that you'd want to go ahead and take advantage of. One other way to actually be independent is to get your first degree. In other words, once you have gone through one undergraduate program and you have a degree and you're going on to grad school as an example, now you're automatically independent because you have your first degree. All right, so that was a tangent. Let's go back to the Pell Grant. Often we see the Pell Grant going to the independent student. We all know there's broke students out there. If the student also has to report mom and dad, now we're talking about incomes under $25,000, $30,000 typically to get anything substantial on the Pell Grant program. So if your family income is really low, and I've seen situations, especially in the financial meltdown that we had a few years ago, where maybe a business was struggling and the family income went to zero. So I've seen some families qualify for various grants where you would think maybe they wouldn't normally. And again, also the very poor families can also apply for the Pell and receive them. We also have the Supplemental Education Opportunity Grant. It's distributed pretty much on the same criteria as the Pell. And again, it's generally only available for families in a very high need situation. The next idea is work study. Work study is a program that's administered by the federal government. Now, work study is a job on campus. Now, the reason it's a federal financial aid program is because the student is paid by the college, but the college gets some money from the federal government in order to help supplement that salary. So colleges like the work study program because they get labor from the student at a very low cost. Now, the students like it because they actually earn some money. Now, understand that the student is, say earning $8, $10, $12 an hour, something like that, depending on the school and what they're capable of doing. But that money that they are paying is, or the money that they're earning is a wage just like any other. So they're going to be on the payroll program just like any other worker. They're going to get a paycheck twice a month or every 2 weeks or whatever it might be. And they'll cash their check or have it deposited and they can spend it on anything they want. It's not automatically garnished and applied to tuition as an example. It's just paid to them like any other job. It's assumed that they will use it on something worthwhile like books or tuition. They could just as easily spend that money on spring break. There's no requirement as far as what they do with that money. So what's the major advantage of that as compared to working at the fast food restaurant down the street? The one main advantage to work study, remember, income and assets of the student could have an impact on financial aid. Work study as income does not impact financial aid for the next year. So if you look at a student's income and you say, oh, okay, well, they had a job, it was work study, and they earned $5,000. That $5,000 they earn under work study does not need to be reported for next year's program. Or I guess technically it'll be reported, but it will also be excluded because they'll ask that question as well. Now, as you may recall, I mentioned that students can earn up to $6,000 and it doesn't have any impact anyway. So if your student earns, say, $3,000 or less in a year or $6,000 or less in a year, it doesn't really matter what type of work it was. But as soon as they earn more than $6,000, having work study will help them for financial aid the next year. And then I think another benefit of work study is on a lot of college campuses, they reserve a lot of the really good jobs for work study. So the technical people that work the help desk or work in the library. There's a job potentially you work in the library between 10 p.m. and 2 a.m. and nobody bothers you. So you're working and minding what's going on there. But in general, you just get a lot of studying done and an occasional question. Well, that job might only be work study. So you need to qualify for work study in order to get that job. All right. Next, we have the Perkins loan. Perkins loan is a loan to the student paid back by the student. Mom and dad are not involved. Now, the Perkins loan is a program that's operated by the colleges themselves. So they do the work to determine how to hand out the money. In a typical Perkins situation, the college might get, let's say, $500,000, and they decide how to hand out that $500,000 in the form of loans to their neediest students. So a typical Perkins loan might be $3,000, $4,000, $5,000, and it's determined by the college itself to determine, well, who among our applicant pool has the highest need and therefore it qualifies for the Perkins. So there's a lot of families out there that may not receive a Perkins loan even though you show a need, because the Perkins money was applied to students that showed a greater need. Now, on top of that, there's some colleges that don't even operate the Perkins loan program. The Perkins loan's not available at their school. So that would be a question potentially you could ask the financial aid office as part of your visit. Now, again, the Perkins loan is a loan to the student. Mom and dad are not signing. They're not co-signing. It's at 5% right now. So it's at a 5%, and the interest is deferred while the student is in school. So if you borrow $3,000 as a freshman on the Perkins loan, when you graduate, you'll still only owe $3,000. Next, we have the Stafford loan. Now, we have a subsidized Stafford loan, and it works exactly like the Perkins loan as far as deferral. So on a subsidized Stafford, you also do not pay interest while you're in school. So you borrow $3,000 on a Stafford loan, and if it's a subsidized Stafford loan, you don't pay interest while you're in school. Now, the Stafford loan also comes unsubsidized. Unsubsidized means you still don't have to pay while you're in school, but the interest that you're not paying while you're in school is added to the principal. So you borrow $3,000 on an unsubsidized Stafford loan. You still don't have to make payments while you're in school, but you graduate 5 years later, and instead of owing $3,000, you might owe, say, $3,800, because all the interest that you didn't pay for the 5 years is added onto the principal. All right, so we've got the subsidized and the unsubsidized Stafford. Both are loans to the student, and the Perkins loan, which is a loan to the student. The Stafford subsidized is need-based. The Stafford unsubsidized is not need-based. So in order to qualify for the Pell Grant, the supplemental grant, work study, Perkins loan, and the subsidized Stafford, you need to show a need. Those are all need-based programs. The unsubsidized Stafford loan is not need-based. So any student out there pretty much can borrow on the unsubsidized Stafford loan. Now the maximum you can borrow as a freshman, however, is $5,500. And the maximum that you can borrow subsidized of that $5,500 is $3,500. So what does that mean? Well, if your family does not qualify for need-based aid, essentially your need is zero, then the most your student could borrow is $5,500, and all of that money would be unsubsidized. So you would pay the interest, or you wouldn't pay the interest, you would accrue the interest while you're in school, and when you graduate, you would owe more than what you borrowed. If you do show a need, then up to $3,500 of that Stafford loan could be subsidized. So in that situation, you may get $3,500 as a freshman subsidized, where the interest is paid by the government until you graduate, and an additional $2,000 unsubsidized. The unsubsidized portion, the interest is accrued while you're in school. If you choose, you can not take the unsubsidized portion and just take the $3,500 that's subsidized and find another way to cover the $2,000. Now, the Stafford loan for all cases right now is at 3.86%, and we'll talk about how those interest rates change in a minute here, because the last program I want to talk about is the PLUS loan. Now, the PLUS loan is a loan to the parents, paid back by the parents, the student's not involved. So when you talk about a PLUS loan, again, it's the parents that are borrowing the money and using it for college, but there's no requirement. The student is not on the hook for any of it, and if it does not get paid, they go after the parents. Now, it's not unusual for parents to say, well, I'm going to borrow this money on the PLUS loan, but you're going to pay it back. And that's fine until the student stops paying. If the student doesn't pay, they don't chase the student, they chase the parents. So you need to be careful if you're going to borrow PLUS loans. In essence, what you're doing is relending it to your son or daughter. And in that case, hopefully they'll pay you back. But if they don't, you'll still be on the hook for it. Now, the maximum PLUS loan is cost of attendance minus any other aid. So remember the last program we said cost of attendance is tuition, room and board, books, fees, beer, and pizza. The whole cost to go to college. So at Harvard and Yale, it's somewhere in the neighborhood of $60,000. So theoretically, you could take a PLUS loan all the way to $60,000 for each year of college. Now, if the student qualifies for any sort of aid or other programs, that reduces the maximum PLUS loan. So it's $60,000 minus whatever other aid the student receives, like the Stafford loan or work study or the Pell Grant or scholarships and so forth. But the PLUS loan essentially is designed to fill the gap. You take what the school costs minus all the other aid that you've received, and typically you can borrow the PLUS loan to fill the gap. Now, the PLUS loan is currently at 6.41%. So the interest isn't great, but it isn't awful, and it's actually better than what it used to be. Now, the rates that I just quoted you, if you're listening to this in the future, are for the 2013-14 school year, which is current as I'm recording this, but they will change every year. In July and August of 2013, they enacted new legislation that changed how interest rates were calculated for the Stafford and the PLUS. So the Perkins loan is 5% fixed. It has been 5% fixed for a long time and hasn't changed recently. But the Stafford loan and the PLUS loan, Congress just recalculated or changed the laws on how they're calculated. So for both the Stafford subsidized, the Stafford unsubsidized, and the PLUS loan, all of those interest rates are tied to the treasuries. All of those interest rates are fixed once you receive the money. Every year, the government is going to declare a new interest rate based on where the Treasury is at the time. So there's pretty much a consensus out there that Treasuries are pretty low right now. And it's likely that the Treasury interest rates will climb over the years going forward. And then when those climb, the rates on the Stafford and the Plus will also climb. Now, the new interest rates only apply to new money. So if you borrow money at 3.86% this year on a Stafford loan, it is fixed for the life of the loan. But next year, when you go to college for your sophomore year, now they declare a new interest rate next May, and you may get it at a better or a worse rate. And then that piece of money will be locked in at that rate, and then you'll do it again for your junior year and again for your senior year. So they will make an offer every year. You can decide if it makes sense to use that money at that rate. You're not required to take it, obviously. And in some situations, I think families might take loans at these lower rates because there's a lot of Stafford loans, as an example, out there right now that are fixed at 6.8%, where you may be able to do better with the loans that are available here. All right, so those are the 6 programs again, the grant, 2 grants, the work study, and the 3 different loan programs. Now, if you're interested in the loan programs, there's going to be some education. All the loan programs are administered by the federal government now, but they actually distribute the money through the colleges. So if you're interested in receiving a Stafford loan or a Plus loan, you're going to fill out paperwork through the financial aid office at the colleges you're attending. You will, especially for the Stafford loan, the student will have to get some loan education. In the past, the federal government, and even currently, the government is having problem with students not paying back their loans because they didn't realize it was a loan. So now every student has to typically go through some sort of class online or somehow get educated that you are borrowing money, you will be required to pay it back. You have to pay it back whether or not you graduate, and it's a pretty serious situation. One of the challenges with student loans is they do not get discharged in general in bankruptcy, so they will follow you around. Often you hear about students where their tax refunds disappeared, and the reason being if the government will take your tax refund if you have defaulted or you have outstanding student loans to recoup that money. So again, the loan programs are serious business, and the colleges are now required to educate the kids about what they're getting themselves into. But that is the process. So generally, you're not going to deal with applying for loans, though, until very close to the start of school. So typically, you might apply for loans. You'll hear about what the interest rates are in May. Maybe you'll apply in June or July for the coming school year. So it's kind of the last step. If you've got a high school kid and you're saying, well, when do I apply for loans or how do these loans work? It's kind of the last step. You apply to the schools, you get your financial aid package. They award the loans earlier on and say you're eligible for these loans. But you don't finalize the paperwork until the summer after your senior year. All right, that wraps up the 6 main federal programs. There's a couple extra programs out there that would apply for special situations. As an example, there's the teacher programs out there that will allow you to borrow money as a loan. And if you end up teaching in the right types of school districts, typically inner city and high need areas, then they may forgive those teacher loans and they become grants essentially, and you don't have to pay that money back. There's also programs out there for attorneys that are willing to be public defenders and work in high need areas of inner cities and that kind of thing as well. So there's a number of tangential things that would only apply for very specific and special situations. All right, so that was a good overview of the federal programs. Now, in a lot of states, there's also some state programs. Generally, they're not as extensive as the federal programs, but some states will award some sort of grants or scholarships to students based on their need. So as an example, in Wisconsin, if you're a relatively high need, in addition to the federal grants, you may be qualified for another $1,000 or $2,000 in state grants. Some of them are predicated that you be a resident of the state or that you attend school in the state. Those grants are available. And then in addition to the government, another major source of need-based aid is the colleges. The colleges themselves may choose to provide additional scholarships or grant money in order to help fill the gap if you show a need. So a typical college might award you first federal aid. They say, well, you're eligible for the Stafford loan and you're eligible for some work study. And then in addition to that, well, you're going to give you, a $5,000 grant or a $10,000 scholarship to help cover your need. Now, at some schools, they work very hard to fill 100% of your need. So if you do the calculations and you show a large need, then they're going to give you a large scholarship. And if you show a small need, then they may only give you a small scholarship. At other schools, they may acknowledge that you do need it, but a lot of schools don't have enough money to go around. So they may say, yes, you need $40,000 based on the formulas. However, we don't have 40 to give you. The best we can do is 25,000 or 10,000, in addition to whatever the federal award is as well. So if you show a need, typically the college is going to put a package together to try and fill that need. And they will fill that need, again, typically first with federal money, federal loans, federal grants. If you're eligible, they may also find some state aid for you. And then finally, they may use some of their own endowment funds or other sources of money to help you fill your need. Now, in addition to need-based aid, there's a lot of colleges out there that will grant you scholarships based on merit, whether it's academics or athletics. That, of course, is a topic of a different podcast, but we're really focused on, again, the need-based side of things. And then the last area where need-based aid comes into play is outside scholarships. There's a number of outside scholarships from foundations and other sources where their goal is to help families with need. So that's part of the scholarship criteria. Roughly 2/3 of the scholarships in the private sector out there are need-based programs, and about 1/3 are not. So if you show a need, the final thing that you may be able to do is to apply for outside grants, the Coca-Cola scholarship or from the various charitable organizations. There's a lot of different scholarships out there, and that's, again, another topic for another podcast. I just want you to be aware that if you show a need, that need may be filled by the federal government, that need may be filled by the state government, that need may be filled by the college, and that need may be filled by outside resources. And if you do not show a need, a lot of those funds you're not eligible, unfortunately. All right, well, that finishes our need-based program. We'll talk a little bit more about timeline and so forth. We've got a question coming up next. So here we go, and take it away, Steve.
Have a question? Brad is accepting questions from his listeners now. Record a question at tamingthehighcostofcollege.com and get it answered on one of the future episodes.
Hi, Brad. My name is Steve. I'm calling in from Central Wisconsin. I have 2 kids that will be going after college in about 2 years, and I was wondering if you could help me understand what the timeline is for some of the college planning activities that you talked about in your podcast. Thanks a lot for your help.
Steve, thanks for that great question. Let's talk a little bit about timeline. The college timeline starts, I would say, in the junior year, which sounds like you have a junior right now. So if we look at the junior year, most families should be concentrating on things like college visits, college testing, and trying to figure out what schools might be a good fit for your student. Visits, you might be doing things during spring break, during teacher conferences and so forth, and getting out there and checking out the colleges that might be appropriate. Also, you need to be figuring out how many times you're going to take the ACT and or the SAT. Some families do both, some families just one, but you need to understand the differences. And for some families, if you're going to take the ACT or SAT 2 or 3 times, then you need to understand, which test dates will fit into our schedule. And most kids will want to have their testing all complete by the end of their junior year so they can focus on the next step, which is college applications. So through the junior year, you figure out what colleges you're interested in. And then as you move into your senior year, that's when you start with your applications. So the fall of your senior year, you're going to do admissions applications for the schools that are on your list. As you move into the winter time, you're going to do financial aid applications for the schools that are on your list. And most people don't understand, or a lot of people don't understand, that the financial applications are going to start before you know for sure if you've been accepted. So you're going to send financial applications to the same schools that you've sent admissions applications to, but you won't know if you've been accepted yet or not for some of these schools. Financial aid applications are submitted in January, February, in the middle of your senior year. They're going to be based on prior year taxes, as we've learned in these last couple of podcasts. So that application goes in January, February. You will get offers back from the schools once you've been accepted. So a lot of colleges, they'll start accepting you sometime in November or December if they use a rolling admission. Other colleges start accepting in January or February. A lot of the elite colleges pick a particular day and they say, go to the website on this day at this time, and you will be able to learn if you're accepted or not. And until then, please don't bother us, because all people will get their notifications at the same time. Most of the time, you're going to get some sort of acceptance and financial offer in late March or early April. From there, you have to decide what school you're going to attend, and typically you're going to have to send in non-refundable deposits by May 1st. So you'll make a deposit for admission and you'll make a deposit for housing, typically. And both of those will be due May 1st. From there, once you know the school and the price and so forth, you'll be able to determine if you need loans. And through the summer, you work on loans, and in August, you'll get your first bill. Typically, colleges bill you by the semester if they're on the semester system. There's a few colleges out there that are on the quarter system, so they will send you free bills. But the billing process is kind of the last step before you go off to college. Now, if you're for your younger student, you can start now on the financial side of things. There's a lot of families or a lot of students out there that don't quite know where they want to go or what they want to be when they grow up. But parents certainly can start working on figuring out the financial side of college. If you know college is in your future, and you've got, let's say, a high school sophomore, and you're saying, well, we're not sure what school or how much and so forth, you certainly can still start saving if that's going to be part of your plan. You can figure out if you're going to qualify for aid. So there's lots of things you can do even earlier in your freshman and sophomore year. And we're going to talk a lot more about those strategies in a few of the upcoming podcasts. So stay tuned. But I hope this answers your question, Steve. I appreciate you sending it through the website for me, so we have questions that we can answer. If you have a question, you can also submit your questions through the website at tamingthehighcostofcollege.com. On the Contact Us page, there's a button to send us a voicemail, and there's also on the right side of the website, there's also a button where you can send us voicemail feedback with your questions, and we'll be happy to answer them on the next episode of Taming the High Cost of College. Thanks for listening. Goodbye.
Thank you for listening to the Taming the High Cost of College podcast. Now it's time for you to take action. Head to tamingthehighcostofcollege.com for show notes, bonus content, and to leave feedback for Brad. The next step on your college journey starts now.
Brad Baldridge is a registered representative of Cambridge Investment Research and an investment advisor representative of Cambridge Investment Research Advisors, a registered investment advisor. Securities are offered through Cambridge Investment Research Incorporated, a broker-dealer and member of FINRA and SIPC. Brad owns two companies, Baldridge Wealth Management and Baldridge College Solutions. The Baldridge companies are not affiliated with Cambridge Investment Research.